Snowflake reported earnings last night, but shares have dropped precipitously after hours. They've recovered a little bit since then, but what's going on with this high-flying stock? We'll take the next 10 minutes to try and figure that out. My name is Brian Stoffel. Thanks for joining me, and as of the time of this recording, I am a shareholder of Snowflake. So we're going to be talking about the company's fiscal third quarter 2023 that ended at the end of October, and right now Snowflake is about a $43 billion company. Now, on the top line, there was a lot to like. Revenue grew 67%. That was well ahead of Wall Street's estimates. And management gives guidance for product revenue. They filter out their service revenue, and that came in well ahead of guidance as well. On the bottom line, a lot to like. On a non-GAAP or adjusted basis, earnings per share grew triple digits to 11 cents per share, which was more than double what Wall Street was expecting. If we look at margins, all of these are on a non-GAAP basis. There was a lot to like. Now, for gross margin, I just looked at their product revenue. That's the key one that investors should care about. And those expanded, while operating margin more than tripled on a non-GAAP basis and net margin more than doubled. Very positive news. If we look at free cash flow, that went from 9 to 65 million. Net income on a non-GAAP basis more than tripled. And the balance sheet is stellar with $4 billion in cash and no debt whatsoever. Now, that does come at a price, and that price is stock-based compensation. It doesn't cost the company anything, but it does cost shareholders. And at $229 million for the quarter, that's about 40% of the company's revenue, meaning there was a 5.6% dilution. That's something that I'm willing to handle as long as the company continues to grow that free cash flow, but that's not for every investor. Now, management said that their largest segments, which are North America and EMEA, which is Europe, the Middle East, and Africa, outperformed, especially compared to small and medium-sized businesses and the Asia, Pacific, and Japan region. They also said that financial services, which is their largest vertical for customers, grew faster than the 67%, while advertising, no surprise there, and media entertainment grew slower. Also, no surprise, technology was an underperformer. Remember, people pay Snowflake as they use the products to run queries on their data. If there are fewer employees to run those queries, and we know that that's the case in the tech sector, it's going to underperform. Total customers grew 34%. And this is really important. The customers with over $1 million in product revenue are featuring more and more importantly in the company's overall financial health. Those customers were up 94% year over year, and they added 40 of them during the quarter. Now, the other thing I want to talk about real quick is this data sharing. So Brian Feroldi and I both believe that Snowflake definitely has a moat in terms of switching costs, but it's adding a secondary moat in terms of the network effect. Why? Because companies can put their data up for sale for other companies to use, but they can only do that if they're also a member of Snowflake, a customer of Snowflake. So having more of this data shared, they call this a stable edge data sharing, adds to the network effect around Snowflake. And we see that 22% of the customers now have it. The listings of data was up 11% just quarter over quarter. So again, that's really positive. And if we look at these large customers, we'll see that 2/3 of them that are paying $1 million per year they now have at least one stable edge. So that is really good news as well. In fact, the company called out in the conference call saying that it is clearly the network effect is important, and it's really seen in financial services as those different industry players have to share their data. Now, if we go to remaining performance obligations, that's revenue that the company will be recognizing, but just hasn't yet. 66% growth is about equal to what revenue was. So the pipeline is not necessarily stuffed, but it's at least as strong as revenue is. The dollar-based net revenue retention at 165%. That might be down from where it's been in the past, but it is still ridiculously high. If you can keep this above 150, that'd be positive. Again, this means that existing customers are spending 65% more than they were last year, and that includes what happens with churn. Moving on, we see that operating leverage is starting to really kick in. Sales and marketing, R&D, general and administrative, while it might be going up, it's going down as a percentage of revenue, which means that more and more of what the company brings in gets generated into free cash flow. In fact, 21% of what they've brought in over the past 9 months has become adjusted free cash flow. Now let's turn to guidance. Management said that product revenue will grow at a midpoint of about 50% per year. Wall Street, when you include that professional revenue, was hoping for a little bit more at 53%. And on the bottom line, there's no guidance. Wall Street's expecting 4 cents per share. Now, management did say that over the past 6 weeks, which means sometime that includes not the quarter that they just reported, they've seen weaker consumption in the Asia Pacific, Japan, and among small and medium-sized businesses. However, and this is why those $1 million customers are so important, the consumption patterns amongst those largest customers give them confidence that they're going to continue to grow. However, they wanted to be as conservative as possible when forecasting for the fourth quarter and next year. And we'll get to next year in just a second. For the rest of this year, management is calling for 67% growth, a little bit shy of Wall Street's estimates. Wall Street's expecting 16 cents per share. I wouldn't be surprised to see that revised upwards significantly given the beat today. Now, turning towards next year, it's fiscal 2024, but it's calendar 2023. It starts on February 1st. They expect revenue growth of 47% and about 23% will become adjusted free cash flow. To put that in perspective, that means roughly $3 billion in sales and roughly $700 million in free cash flow, which is a significant, probably almost doubling of where free cash flow is on a trailing 12-month basis right now. So what am I going to watch as an investor moving forward? First, that net revenue retention. If it stays above 150, that's great. Second, those $1 million customers are increasingly important, so I'm going to keep an eye on them. Third, those stable edge customers. Remember, that's where that secondary network effect moat comes into play. And finally, free cash flow. There's no doubt in my mind that the moat around this business is widening, and the thesis is very much on track. When Brian Feroldi last ran this through his check score, it got a 77. For me, it gets a 12, which is in the anti-fragile range, which is why I own it. But what about valuation? Well, before we get to that, I just want to let you know that Brian Feroldi and I are really excited. We're going to be teaching our third cohort of Financial Statements Explained Simply. This is a course that has been a lot of fun and really popular. It'll be starting the second week in January, where we're going to go over how to read a balance sheet, an income statement, a cash flow statement, and we've gotten great reviews from the students in our first two cohorts. In fact, it's one of the top rated courses out of all of them in Maven. We're really excited about it. If you'd like to join our waitlist and more importantly, get an email with a code for the biggest possible discounts, just see the show notes below, put your email in, and you will get that. So, looking at valuation, we believe that the company is between stage 2 and stage 3, definitely in hyper growth, at least above break even on a non-GAAP basis, not on a GAAP basis yet for profitability, which means that really just revenue and gross profit are the only thing that the income statement is optimized for, meaning that price to sales and gross profit are probably the most helpful evaluation metrics. Now, on a price to sales ratio, if we throw in what happened yesterday, it's trading somewhere between 23 and 27 times sales. That's ridiculously expensive compared to the market, but the cheapest you've ever been able to buy shares of Snowflake. And the same can be said for gross profit, which after yesterday sits about $920 million over the last 12 months. It's trading between 45 and 50 times that figure. Again, that's ridiculously expensive, but better than you've gotten at any other point. Free cash flow is less meaningful, trading for between 125 and 150 times free cash flow, depending on where the stock opens up. But importantly, does this falling stock price affect the company? Not at all, because it is in the self-funding phase. It is churning out free cash flow. It doesn't need to raise any funds. It's got $4 billion in cash in its coffers and zero debt. So that's not something that shareholders need to be worried about. Overall, this was a very positive quarter for the company. It is one that I'm going to be looking to maybe add shares to. I have to check. I don't add once a stock becomes 5% of my portfolio, but between now and the end of the year, I could be adding to shares of that. Let us know if this was helpful. Give us a thumbs up if it was. It helps us get discovered. And if we missed something or you disagree, let us know in the comments section below. We'll see this one in 90 days. Until then, Brian, out.